Welcome to Day 53 of Future Business School's Daily MBA series. Today's topic is international trade and foreign investment, where we'll explore key concepts like the World Trade Organization, foreign direct investment, trade barriers, and real-world case studies. International trade, an overview. International trade involves the exchange of goods and services across national borders. Countries engage in trade to access resources, products, and markets that aren't available domestically. It also allows them to specialize in producing goods where they have a comparative advantage, boosting efficiency and economic growth. The World Trade Organization, or WTO, is the primary international organization governing global trade. Established in 1995, its goal is to ensure that trade flows as smoothly, predictably, and freely as possible. The WTO provides a forum for negotiating trade agreements, resolving disputes, and enforcing trade rules among member countries. Key functions of the WTO include trade negotiations, which facilitate negotiations between countries to reduce tariffs and other trade barriers. Dispute resolution, offering a platform to resolve disputes that arise when countries violate trade agreements. And monitoring, regularly reviewing members' trade policies to ensure they comply with WTO rules. Foreign direct investment, or FDI, occurs when a company or individual from one country makes a substantial investment in a business or real estate in another country. FDI can take the form of establishing a new business, acquiring an existing business, or entering into joint ventures. There are two main types of FDI greenfield investment, which involves creating a new business from scratch in a foreign country, and mergers and acquisitions, which means acquiring or merging with an existing business in a foreign country. FDI benefits both the investor and the host country. For the investor, it offers access to new markets, resources, and potential for growth. For the host country, FDI brings in capital, technology, and jobs, which help boost economic development. Despite the benefits of international trade, countries often implement trade barriers to protect their domestic industries. These barriers can come in several forms. Tariffs, taxes on imported goods, making them more expensive for consumers in the importing country. Quotas, limits on the amount of a specific good that can be imported. Subsidies, financial support provided by governments to local businesses, making their products more competitive. Non-tariff barriers, regulations, standards, or other policies that restrict imports, such as safety regulations or customs procedures. Protectionism is a trade policy where a country raises barriers to protect its domestic industries from foreign competition. While protectionism can safeguard jobs in the short term, it can also lead to trade disputes, inefficiencies, and reduced consumer choices. Case Study 1. China's Belt and Road Initiative, or BRI. China's BRI is one of the most ambitious foreign investment projects in recent history. It involves massive investments in infrastructure projects such as roads, railways, and ports across Asia, Europe, and Africa. China's aim is to boost trade by improving connectivity between countries, while also expanding its political and economic influence. For the participating countries, the BRI provides significant infrastructure development, but has also raised concerns over debt sustainability and geopolitical influence. Case Study 2. The US-China Trade War. The trade war between the US and China, which escalated in 2018, is an example of protectionism in action. The US imposed tariffs on a wide range of Chinese imports, and China responded with its own tariffs on US goods. The trade war affected global supply chains, increased costs for businesses, and created uncertainty in global markets. It highlights how trade barriers can disrupt international trade relationships and economic growth. Impact of trade and FDI on global businesses. Access to new markets. International trade allows companies to expand their customer base beyond domestic markets, increasing revenue and growth potential. FDI can help businesses establish a physical presence in new markets, providing closer access to consumers and local expertise. Lower costs and increased efficiency. Through global trade, businesses can source raw materials and components from countries where they are cheaper or more abundant. This can help reduce production costs and increase overall efficiency. Technology transfer and innovation (FDI) often leads to the transfer of technology, expertise, and skills from the investor country to the host country. This can spur innovation and modernization in industries, boosting competitiveness in the global market. Risks and challenges. Global trade and investment come with risks, such as exchange rate fluctuations, political instability, and changes in trade policies. Companies operating in multiple countries must be prepared to manage these challenges and adapt to evolving regulations. Future trends in international trade and FDI. Digital trade. The rise of e-commerce and digital platforms has changed the landscape of international trade. Digital goods, such as software and streaming services, are increasingly becoming part of global trade flows. This trend is likely to continue, with more companies entering the global digital economy. Sustainability and trade. As the world grapples with climate change, there's growing pressure on businesses to make international trade more sustainable. Governments and businesses are focusing on reducing carbon footprints, promoting renewable energy, and developing more eco-friendly supply chains. Regional trade agreements. In the future, regional trade agreements may play a larger role in shaping international trade. Agreements such as the European Union and the United States-Mexico-Canada Agreement promote trade between member countries, often providing a competitive advantage for businesses operating within those regions. Key takeaways. International trade enables countries to specialize and exchange goods and services, boosting economic efficiency and growth. The WTO plays a critical role in governing global trade, reducing trade barriers, and resolving disputes. Foreign direct investment allows businesses to expand globally, bringing capital, technology, and jobs to host countries. Trade barriers, such as tariffs and quotas, can hinder international trade, while protectionism can lead to trade disputes and inefficiencies. Global businesses benefit from access to new markets, lower costs, and innovation, but must navigate risks such as political instability and changing trade policies. That concludes Day 53 of the Daily MBA series on international trade and foreign investment. Understanding how global trade and investment impact businesses is essential for future business leaders. Stay tuned for tomorrow's lesson on global entrepreneurship and innovation. Don't forget to like, share, and subscribe to Future Business School for more daily insights.